Hello. Now, let's define liabilities a little bit more, specific here, carefully. Liabilities we'll refer to as probable future obligations, typically to pay assets, usually cash, or to provide services to another entity. Liabilities are a company's debts. Now again, probable, here are the key words. Again, it's not critical that you memorize this whole doggone definition, but here are the critical terms. It's a probable future obligation. Most liabilities are paid in cash. We're saying probable future obligation to pay assets in the future or to provide services. The assets that we typically pay when we pay obligations is cash. Some people have suggested, well, if you have an obligation or a liability, we probably ought to refer to it on the balance sheet as cash payable. I mean, that would be a proper description of the fact that you have an obligation to pay cash in the future. But since most of our obligations are going to be payable in cash, to simply reflect a liability on the balance sheet and say total cash payable might be accurate, but it certainly isn't providing really any discriminatory information. Show us what kinds of obligations. Typically, when you look at the balance sheet, you will see the liabilities not referred to as cash payable or in terms of how we're going to pay it, but rather we'll describe and define these liabilities in the balance sheet on the basis of why we have the obligation to pay cash. For example, a common liability appearing on the balance sheet is accounts payable. Now, this is an important and common business term. What does it really mean, accounts payable? Accounts payable specifically is an obligation arising from the purchase of inventory on account. For example, if it's Walmart and Walmart is purchasing some merchandise and they're purchasing, for example, popcorn poppers and toasters from General Electric. They probably have an arrangement with General Electric where they will buy this merchandise on account, meaning that they'll pay for it within 30 days. This is a common accommodation in transactions between businesses especially. So if a business buys merchandise or inventory but doesn't pay for it immediately, they're incurring an obligation to pay for it in the future. We will refer to that as accounts payable. We may have some future obligations to pay cash to employees if they've worked for us, and now we are going to be obligated to pay them for that, but haven't paid them yet. We would reflect that future obligation as, again, instead of calling it cash payable, we'll describe it in the terminology that describes why we owe it. We'll call it wages payable. If we have utility bills that we're going to have to pay in the future, we'll call it utilities payable. Another common liability is referred to as notes payable. A note payable arises as a result of borrowing cash, not buying inventory on account. For example, if you were going to capitalize your business and go down to the local bank and borrow $100,000, and by some miracle you actually qualified and they did loan you $100,000, in that particular case, they would probably have you sign and execute a document referred to as a note or a note payable. And we would reflect the $100,000 obligation. We've borrowed $100,000, are going to have to pay it, repay it in the future. Again, we won't say cash payable, although that's accurate. We are going to pay it in cash in the future. We'll refer to it by how or why we have that obligation, and we typically call it a note payable, maybe even note payable to the bank or something like that. Now, one other kind of liability that is at least worth mentioning at this point in time is warranty obligations. The reason why I want to mention this, although it is a little bit more complex than some of the liabilities that we're talking about right now, wages payable or utilities payable, those are easily understood, is to make it clear that there are some liabilities that exist that do not represent cash that's payable in the future, the obligation to pay cash. In fact, if we look back up at the definition, liabilities are probable future obligations to pay assets or provide services. Provide services. If you have an obligation to render services to some other entity, business, or individual, that is a legitimate liability that should be reflected in the financial statements at the value of that of the services to be rendered. For example, many businesses will sell merchandise and provide some kind of a limited warranty, saying that, hey, if this TV set, for example, or computer breaks down within the next 6 months or within 6 months of your purchase of the equipment, we'll come out and we'll fix it for free. Well, what you're doing is you're making a promise to provide future service. The question is that probably actually going to happen? I mean, if in fact you're going to reflect this promise to provide future service under a warranty as a liability, the question is it really probable? Well, if your own experience is that, about 25% of the time these TV sets or computers or whatever, tend to break down and it costs about $50 a shot to fix them under the warranty, now you actually know that it is probable and might even be able to determine some amount that's probable in terms of the future obligation to provide warranty service. If in fact you can make those determinations, you probably have a legitimate liability that should be reflected on the financial statements, even though you're not theoretically going to pay cash, you're simply committing to provide services. The last element of the balance sheet is referred to as owner's equity. This is the term that most students have a tendency to really struggle with. What is owner's equity? As a result, I'm going to try and kind of approach this term and define it in a variety of different ways, hoping that, for some of you that may struggle with it, there's something in there for everybody to really kind of hang their hat on. The simplest way to define owner's equity would be to simply do it algebraically. For example, if, again, given the basic accounting equation that assets equals liabilities plus owner's equity, if in fact we were to kind of isolate owner's equity in this equation algebraically by deducting liabilities from both sides of the equation and isolating owner's equity on the right-hand side there, then the definition of owner's equity is the amount of assets minus the amount of liabilities. In fact, if we had $100,000 of assets and liabilities amount to $60,000, owner's equity is the difference, or $40,000. And frankly, on an exam, if I asked you to define owner's equity, if you simply said assets, or the amount of assets, minus the amount of liabilities equals the amount of owner's equity, I would say, hey, that's absolutely right. Perfecto. Another way to define owner's equity is from the perspective of the amount of assets provided by owners. Again, we've mentioned that this basic accounting equation is a representation of the capital of the business. The assets of the business are the resources of the business. The right-hand side of the basic accounting equation shows how we got those assets. In fact, this reflects how the business has been financed. The right-hand side liability says how much of the resources or assets of the business have been financed by borrowing, where we have an obligation to creditors. And owner's equity represents the amount of assets that the company has possession of or resources, has obtained those resources from the owners. So what we're really looking at here is the amount of debt financing and the amount of equity financing, or the amounts provided by owners. Again, looking at this owner's equity from the standpoint of it being the amount of capital provided by the owners to the business, if that's how we're defining it, I'm going to suggest to you that there really are only two ways that owners provide assets to a business. One of these we've discussed. Contributing cash or other assets to the business in exchange for ownership interests evidenced by shares of stock is one of the ways that owners provide capital or resources to a business. They put money into a business typically in exchange for stock, which is simply a representation of their ownership interest. This amount, the amount that has been contributed in exchange for the ownership interest for the owners, is referred to as the amount of contributed capital. Or in a corporate setting, we would simply refer to it as the amount of capital stock. Those two terms are really synonymous. The amount that was contributed to the business in exchange for ownership interest in the form of stock is referred to as contributed capital or capital stock. It is one of the ways that owners provide resources to a business. The second way that owners provide resources to a business is by allowing any increase in assets arising from the profitable operations to be retained in the business rather than distributing those resources to the owners in the form of a dividend. This amount is referred to as retained earnings. Let me kind of amplify this a little bit. Heck, the whole purpose of a business is to get capital or resources and then to use that capital and resources in providing goods and services to customers to create more resources. I mean, that's really what we're trying to do. We're trying to take some assets that we've gotten from creditors and from owners, take those assets and create more assets through our productive operations. If in fact through our profitable operations we create more assets, who has a right to those resources created through profitable operations? I mean, who are the beneficiaries of the profits, the increased resources through profitable operations of a business? It's the owners. Heck, that's the reason why they put the funds in the business. That's why the reason why they contribute capital is that so the business can actually generate a profit and then distribute that profit to the owners as a return on their investment through what we call a dividend. Now, in some cases, the owners of a business may decide that even though we've had profitable operations, instead of taking those resources created through profitable operations out of the business for our own personal use, wait a second, let's keep those profits in the business. Let the resources that we created through our profitable operations, let them stay in there and kind of help to build the business, capitalize the business through the earnings of the business. So this term retained earnings is very appropriate and descriptive. The earnings are the increased resources created through profitable operations, and if owners decide to allow those resources, they have a right to take them out, but if they allow those resources to be retained in the business, it is effectively a second way that owners are actually providing resources to the business by allowing the earnings of the business to be retained in the business in the form of the resources and allow them to continue to grow. So another way to really define owner's equity is owner's equity is equal to the amount of capital stock, which is the amount of assets contributed by owners in exchange for stock, plus the amount of assets created through profitable operations that the owners allow to be retained in the business. Now, if I were to tell you that owner's equity, given this little example that we've been going through, that the owners have provided resources to the business, owner's equity equals $40,000. And if in fact I told you that the owners had contributed to the business in exchange for their ownership interest $10,000 of the $40,000, then if I were to ask you how much have the owners earned but allowed to be retained in the business as a result of profitable operations, you'd know that would be $30,000, because there are only two ways that owners provide resources to a business. And owner's equity is the amount of resources in total that have been provided to the business. And it's done either through contributions in exchange for stock or by allowing earnings to be retained in the business.